Today's presenters are GBQ State and Local Tax Services Directors Matt Stamp and Jeff Monsman. Now I'll turn the call over to Matt to start today's presentation.
Thanks, Kyrie. Good morning, everybody. So this first slide is just our standard disclaimer. Talks about the presentation is intended to make participants aware of certain tax issues that we have going on. Not intended to be tax advice, and please seek your qualified practitioner. Again, my name is Matt Stamp. I'm the Director of State and Local Tax Services for GBQ. We thought it would be good to kind of go through the latest sales and use tax developments for everybody. And I think we kind of broke it down into three, if you look at the agenda, kind of three different areas. I'm going to cover legislative updates, meaning the current budget bill that just went through, plus then, kind of the highlights and then pending legislation. Then we're going to switch to administrative updates. I'm going to go through audit process and final determinations. And then Jeff is going to pick it up from there and hit refunds and then kind of go through case law updates with the significant cases in sales and use tax that have hit Ohio. So we'll talk a little bit of multi-state, a lot of Ohio, and try to get you some updates that hopefully will help you. Next slide, please. This is the first CP activity code word. It is Ohio. Again, Ohio. Next slide, please. All right, so we're going to start off with the budget bill. So just want to give some highlights of the budget bill, not all of it sales and use tax, but just hit the high points. But basically the 2022-23 budget bill was House Bill 110. Just the highlights: personal income tax, there was some reductions in the non-business income tax rates, and the highest income tax rate has been adjusted to 3.99%. I think you're going to continue to see more pressure to push to a flat rate. I think there's a lot of legislators that want to see a flat Ohio personal income tax rate. If the economy continues to go well and we continue to have surplus in cash, even through COVID, Ohio didn't dip into the rainy day fund, so there's still a significant amount of money sitting there. I would suspect that the legislators will continue to want to reduce the income tax. I think the major issue, though, that's kind of, they're reducing the state income tax rate, but we still have this municipal income tax issue that they're allowed to impose. So, when you think of income tax rates, you got to kind of add them together, which makes Ohio still a high rate. As far as changes the municipal income tax, they did reinstate the temporary rules for employer withholding through the end of this year. Basically, that says that employers could withhold where the employees were, where their work location was, and not have to go into where their home location, since so many people were working from home through COVID. And then it shields employers for certain penalties. This is important because starting in 2022, you're going to have to really focus on, it's going to go revert to the old rules, which is back to principal place of work, and that's going to have a lot of adjustment for people because there's going to be, I think, significant amount of people that are going to work from home. And then with the commercial activity tax, they went ahead and make the exemption for the Bureau of Workers' Compensation dividend payments. So when those were returned to employers, there was a lot of discussion about intent, and the Department of Taxation came and said, well, you know what, those refunds are going to be taxable. So the legislature said, that's not really our intent. Our money was to return that money to those individual businesses, and so they went in and made an exclusion to go ahead and make those exempt. So that is kind of the updates on those items. If you want to switch, and we'll switch slides, and we'll switch to some of the sales tax updates. So the biggest item here is the elimination of the sales and use tax on employment services and employment placement services. So this tax has been around since 1993. It's really, from a lot of legislators and businesses' view, it was not really a good tax. The problem is that it generated a lot of revenue. And really it was, providing or supplying personnel on a temporary or long-term basis where there was direct control and supervision by the buyer. And so, it was always set up to be like the manpower that Kelly, you get temporary services in. Over time, it expanded to, the IT technology world, engineers, accountants even, and it really manufacturing, like, so a lot of industries, construction, they were all impacted by this temporary employees. And then there was, certain exclusions that were put in on contracts greater than 1 year. And all this really came up to a large amount of litigation. So there's tons of cases where people trying to get out of the tax. And the problem with the tax is that it was a tax on not only the service provider fee, but it was also a tax on the wage base. So you had these temporary employees, and then whatever their wages were also taxed from a sales tax perspective. So we're really kind of an unfair tax. Like I said, it just created a lot of litigation, a lot of people being caught by surprise, I guess employers on audit about what services they were buying. Am I buying just the temporary employees, or am I buying a project to get finished when I have a consultant in? So there was a lot of litigation around the true object of really what was being purchased. So effective October 1st, the taxes are going to be no longer applicable, so that companies don't need to worry about it anymore, about paying sales tax on employment services or employment placement services. So the question is like, what's next? And I think what we've kind of been talking about to our clients is that you really got to review what the business impact is. So you need to make sure you're reviewing your vendor contracts and service agreements to make sure, starting October 1st, you're not going to be paying any more tax related to these engagements. And review your vendor invoices. One of the other issues is for direct payment permit holders, and that's because a lot of times they'll either use a single rate percentage, or they'll pay accrue use tax based on a percentage by account. And so we're talking to them about basically what they need to do is evaluate their expense accounts to determine where those percentages include the temporary employees, to go ahead and eliminate those. So it's going to reduce their taxable percentage in either by account or single rate. And for some, it's going to be a big dollar amount. So they want to make sure that as of October 1st, that they make adjustments so they're not accruing on a monthly basis, that it's going to be, there'll be overpayments is what would happen. So that's the first thing. On audits, you're going to want to make sure that you're not going to do, you got to make sure that the samples, especially the farther you get along in this kind of period where you're going to have an audit period where you're going to have some periods where it's taxable temporary employment, other periods where it's not going to be taxable. You don't want to have that like skew your sample. So for an audit perspective, you want to kind of pull it out, look at it separately, because you're going to have cutoff periods of what's taxable and what's not. And then the other idea is we talked about with vendor invoices for refunds. Just going to talk a lot about the refund process and what's going on there. I would just say that, if you don't want to overpay, because you don't want to get stuck in the refund process. And if in the refund process, just it's timing, it's delays, and then the documentation you have to prove to get the refund. Let's just try to do it right from the beginning so that we don't run into these issues. Next slide, please. So we talked about the budget bill. The budget bill did not include a ton of sales and use tax changes other than this big change on employment services. And back to why that got through, I think a lot of it was a bad tax. But the other issue is that, again, Ohio was in a surplus. They could afford to eliminate the tax and not feel that they were losing a ton of revenue. I guess the impact wouldn't have been as great. So moving forward, the pending legislation, there's really only two items that are out there right now. Not sure how much play they're going to get getting passed. Just they're getting thrown out there. The first one is Senate Bill 221, and that's an expansion of the sales tax holiday. And it's basically the back to school sales tax holiday. So it increases the price for singular items of clothing and school supplies to be $100, and then it adds a new provision for laptops, netbooks, or tablet computers that are for less than $2,000. So just a little tweak to increase the benefit for the expansion of the sales tax holiday for back to school. The next one is Senate Bill 222, and this is the addition of a sales tax holiday for qualifying Energy Star products. And so it's proposed as a 3-day holiday for the first Friday in March and then the following Saturday and Sunday, so basically a long weekend. So it's going to be pretty limited, though. What they've tried to say is it doesn't apply to a rented device if it's purchased for use in business. It's not going to qualify. And the other one, the bigger one, is contractors that purchase the device on behalf of the ultimate consumer. So if you have somebody that's going to purchase and install a dishwasher for you that's an Energy Star product, that's not going to apply. It would have to be you, the consumer, go out and buy it, and then maybe you could have your contractor install it. But you have to be the ultimate consumer as the individual of the Energy Star product to qualify. Overall, I'm not. These are just some of those provisions that kind of get stuck in there. I don't know if it'll go anywhere or not. We'll just keep updated. We'll send out a SALT watch if these things end up going anywhere. Next slide, please. So the next section we want to talk about is administrative updates and what we're seeing in Ohio and multi-state as far as the administration of sales and use tax. So one of the first questions we always get, especially if somebody gets an audit notice, is why am I the one that got selected? And so what we're seeing from the department in Ohio and from other departments across the country is they're using big data, basically data analytics, to identify those companies who they think have there's a better opportunity for there to be mistakes or missed opportunities or less tax being paid than should be paid. So they look at business profiles and comparisons. They look at if you have, let's say that you have a sales tax account and you're remitting a bunch of sales tax, and you have either a use tax account with $0 remittances or other withholding accounts. Like, they're using that data, cross-referencing it, and then that is what's flagging who they think they should be sending notices to. So that's kind of, they're also getting information from the IRS, Homeland Security. We've had multiple occasions where we've gotten clients that have actually gotten hit from customs, meaning they had purchased items overseas, had them shipped in, and then got identified that way. And the other one that we've seen a lot of is like titled property, like ATVs and other items, boats, planes, everything like that. That there's questionnaires going out. A lot of people claiming ag exemption for like ATVs and different vehicles, and the department asking questions about whether that really truly qualifies. So a lot of different ways that things are getting selected for audit. The other one that's pretty much always on the audit list is direct payment permit holders. It's just a cycle that they want to make sure that because you're not paying sales tax to any of your vendors, that you're taking it all and accruing use tax and remitting it monthly. They want to make sure that that's done right. So generally it's larger taxpayers, but they are always in auditing direct payment permit holders. They do look at size of company. For smaller companies, it's generally just a random audit that's identified through big data or other ways. The larger companies are usually on an audit cycle, whether that's, they audit them, 3 years and then skip a cycle and then audit them again. It's just, every 10 years, maybe they hit this company or whatever. And then audit history is a big one. So if you get hit on an audit and there's big dollars there, by the time that audit finishes, usually there's another period to audit. So the department will go in and request to audit that period and get them caught up. So a lot of times you'll see audits that end up being, start at 3 years and end up being 6 years or 7 years as they go through, with very little periods missing in between. And the final thing is current hot topics. So, industry types, court cases, new laws, things like that. Currently we're seeing, and I guess from a multi-state perspective, when we're talking about Wayfair or economic nexus, we're seeing a lot of different requests from Maine, Wisconsin, Massachusetts. Regular audits, we're seeing Ohio, Kentucky, and Indianapolis. And then, even like third-party audits, we're seeing Alabama local audits and Louisiana parish audits, Colorado. So a lot of local things that are going on. You know, in Ohio, as far as sales and use tax, you know, construction has been on the radar for the last couple of years, probably the last 4 or 5, that construction companies are getting hit a lot. Always manufacturing, and then service companies. So, and then you have the big data trying to just get as many of those that they believe are not paying the appropriate amount of tax to get those audits done. Next slide, please. So, as far as the you know, the audit process, what we're seeing, you know, what we try to tell clients is that, you know, the auditor's only doing their job, so don't make it more difficult for them. You need to treat them with respect. You need to understand that personality conflicts do arise. You know, you're not always going to get along with your auditor, but you want to work with them because, you know, the more time you spend with the audit at that level and the agent to get things removed so they're not assessed, it's going to be a lot better for you as the taxpayer, because administrative, as Jeff goes through some of these appeals and things that happen, the timing and interest just keeps accruing. Things that should have been resolved, you know, need to be resolved at the agent level. So if you have real conflicts, that's what gets addressed later on, and not something that should be addressed with the agent. You can request an audit a meeting with the audit manager. Do it, you know, just if there are certain things that need to be addressed by the audit manager. What we do say is don't go around the agent. So you want to include them in the conversation to make sure that, you know, whatever discussions you have are implemented on the audit. We want to commit to timeframes for completion and monitor progress. This has really been impacted through COVID. There's been we've had multiple audits where the agents have switched because agents have left. They get too busy, delays, audits stack up, and new auditors come on. So there's been a lot of changes. So if you can commit to a time frame for completion, so you don't run into statute issues, waivers, I mean, that's the best way. But sometimes things just take longer than what they need to. From a you know, record speaking, you know, information process, you know, you want to limit what they see, but you can't prohibit. So, you know, you want to designate one person for the audit. You want to, you know, only want to focus on the information that they need to see, they don't need to see everything. And because you don't want to create more work for yourself as you're providing information, you want to give them exactly what they need to get their audit done, because they're just doing their job, and have them, you know, review what they need to review. As far as waivers, there's a lot of waivers going on. Generally, they are to the benefit of the taxpayer anymore, just because of delays. All it does is keep the statute open for a period they've already said they're going to audit, and it keeps you away from an estimated assessment. Next slide, please. A couple of things we always recommend as far as, you know, administrative updates. We always recommend that you do an overpayment analysis prior to the audit. And that's because overpayments, you know, they can reduce the liability, but the auditor's not going to do it for you. So, you know, they may, as they're going through an audit, talk to you and say, hey, you know, you probably shouldn't be paying tax on this, but only if they see it, and they're not going to calculate what the refund is. So if you get on audit notice, you need to understand what your rights are and what issues might be out there for you to get a refund on. And I think Jeff will talk about some of the common things that we're seeing that'll, you know, identify some of those areas where you may want to focus. That, you know, sometimes there's small dollar amounts and they're not really going to help. Other times it could be significant that it could really, you know, really offset whatever you're going to pay. Documentation is key. So missing documentation is bad, because if the department, you know, generally the rule is if they can't identify it, it's taxable. And in a lot of cases, that's, you know, you're going to be overpaying if you don't have the documentation. We always tell our clients to have audit ready files so that there's no surprises. And then, you know, if you're prepared, you can quickly turn around, and then you don't run into, you know, delays on the audit and timing and things like that. If you're ready and you know you have your trial balances ready, you know you have your data that you need to get and pull from the system to give to them. If you know you have access to invoice copies, or they can have access to, you know, your files that have that your invoice in it, that would all be stuff that helps you accelerate your audit, get them in, get them out, and get a good result. Next slide, please. So we talked about audit issues, information requests. So sometimes they are too voluminous. There's a lot of things they ask for. So we try to pare it down, focus on what they really need. They need to see fixed assets. They need to see trial balances, and we only want to focus on certain accounts, right? Like if we can eliminate accounts, that's less invoices to review. We can move quicker through the audit. Sampling has been an issue in that the department seems to be pushing block samples. Sometimes that's okay. Block samples are fine versus statistical sampling. But sometimes you run into what block sampling is. You have to look at a whole lot of invoices, and that becomes very voluminous too. And so the question becomes kind of hand in hand. Like if we do a block sample, how many invoices are we going to have to look at? And then do we have access to those invoices? Are they readily available? And can we get them to the department quickly? So a lot of things come into sampling, and then documentation on what's ready and what can be made available. Some of the other things we're seeing, missing invoices. Like I said, if it's missing, it could be taxable. So you may need to kind of go through multiple similar type invoices, the same vendor kind of thing, to make sure tax is being charged or the tax is being accrued. So you have to work with the auditor on that. And then purchase cards. Purchase cards are difficult because of documentation. So one of the things we try to work with our clients on is having, the guys that are submitting their expenses, there's got to be a process. They've got to get their submitted expenses in, because otherwise, not everybody's charging tax, and the department can't view it. They can't see it. They don't think tax has been paid, and they don't know what it is. So you've got to make sure that you have some sort of documentation around that. We are seeing some problems with knowledge level of auditors, meaning that things aren't getting resolved. It used to be that you would negotiate a lot with the auditor and be able to get some things through. That really depends on the experience level of the auditor. And what we're seeing is that there's a whole lot of auditors that have been new, and they're all coming from maybe different units. There's been some move from refund units and other places to try to get enough auditors to do audits. And so that's been an issue. From administration, we're seeing a strict adherence to processes and statute. So, if the department is viewing things very statute ordered, not looking at business processes or how things work in the real world, it's really focused on, this is what the statute says and this is what we have to adhere to the point where the other issue is that they're not looking at prior determinations that they've done themselves, or meaning that they view it as every audit is a new audit, even though maybe some determinations were made in the past that should stay and follow through that client. They're basically saying that every audit's a new audit and we need to review this again, and we may come up with ultimately a different conclusion. Which can be problematic, especially if you're a taxpayer that's always followed things and done things the same way in the same process. That can be really problematic. If you get into it, especially for manufacturers, plant tours are important. You got to have somebody that knows what they're talking about. You also got to kind of help them understand what the department's looking for. So always do prep for the plant tours to make sure they know exactly where the department's looking, and to know, what should you be focused on when you talk to the auditor and what they'll be looking at. Next slide, please. Penalties, we always talk about penalties because generally on use tax audits, it's 15%. We've seen some adjustments to this, but the only time it's failure to remit where it's been 50%. Penalties are totally discretionary. There is a penalty review committee within the department that it's supposed to recognize compliance and be an attempt at consistency. We've got some standard letters that we've been writing, for the reasons why penalties should be, abated. But we're getting more pushback from the auditors that they want to hear from the taxpayer. So it probably will end up being a combination of both. Some of the things that we say plus some of the things that they say, to try and put the best foot forward to get these penalties reduced. One new thing as far as the administration has done is final determinations. So final determinations are now public record. They used to be, you used to have to go to the department and flip through the final determinations, even though they were open and public access. It just wasn't readily accessible. So I put in here the link that allows you to go in and you can review all the final determinations for all taxes. What we're seeing a lot of as far as those determination is the department saying, hey, taxpayer failed their burden of proof. They failed to provide lack of evidence. A lot of times thinking that, hey, we filed, there's a lot of this where they filed a refund claim and they're using maybe internal, their screenshots from what they filed on the gateway as their proof, but that really doesn't prove that there was a refund due. And so it's very easy for the department to say, hey, done, out, because you don't provide sufficient information. Jeff will go through some of these issues that we're seeing on the refunds and other things and kind of detail what's required. But ultimately, when you go look through some of these final determinations, it's a lot of taxpayers are just throwing refunds or appealing items and not providing enough information to actually win the case. There's also, even if they do, there's also, from the department's perspective, limited details and explanations of why things are exempt or why they're allowing the refund. Sometimes it's just, it doesn't seem like there's rationale, and I don't know if it's just being because they know it's out on the open that they don't really want to explain why things are the way they are, but it appears to be that there's just, it's pretty gray. As far as timing, you'll notice that, we always, they kind of say things are first in, first out. What we've seen is bigger dollar amounts and more complex issues are not first in, first out. They get pushed aside as they can kind of jam through the easy ones first, and then the bigger ones end up being a lot longer time frame. I think with that is my slides, and I'm going to turn it over to Jeff Monsman to go ahead and start his piece.
Great, thanks, Matt. Yeah, so for the rest of this kind of the presentation here, we're going to go through and talk about some of the Ohio refunds and what we've been seeing from the refund unit. I'll talk about some hot topics as well too, as far as what we've been seeing specifically on some audits, on some refunds, things of that nature, and then also to kind of talk about some cases and the applicability of kind of specific fact sets and stuff like that. So kind of, I think the common theme that we're going to see running through, and I know Matt talked quite a bit about it, but the remaining common theme that we're going to see on a lot of these items with sales tax in general really is kind of this focus on documentation of if you have a position, here in this specific point, we're certainly going to be talking about refunds, but in any situation, it really is kind of, making sure that your positions are documented and essentially giving the department no other answer than to kind of rule for you or kind of give yourself the grounds for future appeals if necessary. So, in the context of refunds, that kind of comes out right away. So what we're seeing right now for sales tax refunds is that the waiting period for your refund to be reviewed is approximately 6 months or so. So basically from the date that you file it, you've got about a 6-month waiting period. And the reason for that is a few items. First of all, it's just the backlog and the volume of refunds that get filed on a regular basis. There is a refund unit of individuals who are dedicated to reviewing just refunds. There's about a half a dozen or so, but they're working on staffing that up. And part of those issues too that we're running into as far as the waiting period goes is that some of these auditors that were dedicated to reviewing the refunds have been pulled on to handling kind of larger scale audits and items like that. So there's a bit of a backlog. And then of course, the issue comes is that the volume of information that's provided, it takes some time to review and kind of come to a determination. The good news is, or potentially bad news, depending on how you want to look at it, is that once the refund is assigned to review, the department is expediting it as quickly as possible. Usually after a refund claim is filed, all of the items and the documentation that you are submitting in this situation is getting inventoried, usually by administrative staff, and they're basically checking the boxes of what needs to be provided. If there's anything that is missing from the refund, as far as documentation goes, usually a couple months after the refund claim is being filed is when you'll receive some type of notice or communication from the department to say, hey, these items are missing, you have so many days to provide it, or your refund's going to be denied. That kind of kicks off the process. And so once you kind of provide those items, you'll usually receive some type of contact from the department when the refund is getting reviewed to say, hey, we are reviewing this refund. At least we hope so. We'll talk about that here in a little bit on situations where that may not have happened. Here's kind of a remaining information request that you have to provide. Usually once you get that notification, once it's actually been assigned out, department is giving you about a week or so to kind of provide that additional information. One good thing with that is if you are working with the auditor or working with the examiner in this situation and working to provide that, they are pretty good with providing those types of exemptions or extensions, I should say. But the one thing that you need to kind of keep in mind is that they will not keep these refunds in the refund unit for perpetuity. Basically, they are trying to get these things reviewed and assigned and either approved or denied within a kind of a 4 to 6 week window. The issue that we've kind of always been running into with sales tax refund claims is just providing this voluminous documentation to satisfy the refund request. So as we look in Ohio, the basics of what you need to provide first and foremost is spreadsheet detail of every single invoice that you are claiming refund on, which can build that volume up. You need to provide the invoice itself, copy of the invoice. You need to provide proofs of payment, and you need to provide contracts in this situation. So a couple things I want to hit on in this situation. The proof of payment piece for a long time used to be a major issue and a major sticking point on a lot of these refund claims. And so basically the old rule, I'll call it, was that you had to provide every single proof of payment all the way down to a bank account tying out. Became very burdensome, caused major issues, because if you're talking about a refund claim that's maybe a couple $100,000 with thousands of invoices, next thing you know, you're submitting a refund claim that has tens of thousands of pages, and that's not really an exaggeration. So what the department has kind of backed off on that position a little bit is that you still have to do that for a certain percentage of those invoices, where you're either providing a canceled check, you're showing that it's clearing your bank account, or if you're paying electronically, some type of ACH number to show that, yes, this actually did hit account. For the remainder of the refund claim, depending on the volume, what the department has accepted once they've gotten comfortable with the methodology is something from your accounting system that shows that it actually hit your ledger, hit your GL somehow, and that the invoice amount ties to what your payment amount was on your transaction. Contracts still remain a big issue. I think the underlying theme, again, kind of this documentation piece is that you have to prove that exemption. So basically, there is a strong presumption against taxpayers, or that the tax was charged properly when you're in a refund situation. So you have to prove that you're entitled to the exemption through contracts, if it's a professional service, or if it's maybe a software implementation, which we'll talk about that here later slide. Or some type of item to say, yes, I paid tax on this, and no, I shouldn't have. In the manufacturing context, sometimes it's a little bit easier because you can point to a machine or an item or something that's used directly in the process. You can use photographs. Plant tour sometimes comes up as well too. It's so, there's some things that, you have to go through to really kind of prove that you have that exemption. It's so, that kind of becomes that arduous task. Some of the common refund exemptions that we see and are usually right for the situation is that manufacturing context, because anything that is used within the manufacturing process is exempt. And a lot of times you're purchasing stuff from vendors that maybe sell you items that are used inside and outside the process, or maybe you're not providing the right certificate. So that's always a common one. Packaging kind of part and parcel with the manufacturing, although it is a separate exemption. And also too, recently is the multiple points of use for larger software purchases. So in situations where you're buying a large item of software, Microsoft, for example, is one where everybody has a license in the company. If you're working across multiple states, you only have to pay sales tax on the Ohio portion to Ohio. Now there could be some liabilities in some other states. But at the same time, there are some things that you can do to try to save money based on whether or not, other states are using it, or maybe even other countries that you may be using the software, the taxability and kind of a rate play there. But again, the biggest issue of that goes proving that you're using the software, and then also too that you can get user lists. Typically, the department wants to see names, positions, and where the people are sitting, and kind of do that for each year. So it's not like you can provide one list and have that cover 4 years. Basically, each invoice or each year, if there aren't major changes, typically have to kind of provide for that piece there. Temporary employment, which that's going to be going away, so it's not going to be much of an issue, but there were certain conditions that could be met as far as a contract longer than a year, and a few other ones. I won't spend too much time on that piece today, just because in about another 4 weeks or so, we won't have to deal with temporary employees and their taxability. And a couple other items I want to hit on, regarding where we stand right now with Ohio refunds, and it's not on the slides here, but certainly important of what we've seen from the department lately is that you may be getting a final disposition that is maybe not necessarily being communicated directly to the taxpayers or directly communicated well. And this has kind of happened in a few situations recently, situations where taxpayers are either outright getting denied without any contact from the department, and without even receiving the notice of denial. And that notice of denial or the notice of approval triggers a 60-day appeal window. So it's important to kind of stay in contact that, if you did file a refund claim, it's kind of hitting that 6-month window to check in with the department to say, hey, what's going on with this refund? Because if it gets denied and you never received it, there just becomes issues with kind of triggering that appeal window. And this goes even from refunds too, where a check will just kind of be sent. There might be a portion approved and a portion denied, and you're not getting any other communication. So kind of once you hit that 6-month window of when that refund should really be, getting worked at least, or hearing from the department, lobbing in a call and saying, hey, what's going on with my refund? Has it been assigned? Nothing wrong with that, and just making sure that you're staying on top of it and preserving any appeal rights down the road. Ohio does also have kind of a way to submit documentation online now. It's through the online notice response service. It is good to upload smaller documents and smaller items. We have found that recently, if you're uploading large volumes of either by invoice or size of the document or number of documents, it could be a bit cumbersome there. And then you always run into the issue of kind of, do you have proof that it was actually sent? If you send an email or if you send something certified mail, you actually have that proof of date of dispatch so that you're, not missing statute dates or missing anything from there. So while it is good to kind of do it that way, anytime you can get anything with date stamp timing or anything like that, it's always going to be kind of helpful just to make sure that these refunds are, staying in line and you're not missing out on things statute wise. And then, one kind of multi-state thing that we wanted to touch on real quick was the possibility of audit. So that's always the risk in situations where you're filing a refund claim. State wants to protect their interest, of course. But in some states, Pennsylvania and Texas come to mind, that if you do file a refund claim over a certain amount, it could trigger an automatic audit. So again, when you're filing refund claims, make sure you're kind of doing that exposure analysis so that you're kind of not cutting off your tail in a situation like that. So that's kind of the overview on the refund claim. So Carrie, if you want to jump to the next slide, we'll kind of talk about some current trends and hot topics. And so kind of for the remainder of this piece, as far as current trends and hot topics, what we're going to see here is going to be a lot of these trends are really relate to a lot of the cases that we're going to be talking about here in a little bit as well too. Not a whole lot of cases get litigated through to a final determination, even through the courts, but there are some, and the ones that do get litigated and the ones that do get a final determination are really helpful and should be something that kind of help taxpayers rely to try to do the right thing, but unfortunately it doesn't always come to that context. Cleaning and building maintenance has been that issue for a long time, for as long as I've been doing it, probably for as long as Matt's been doing as well too. He's certainly been doing it a little bit longer than I have. But that this is kind of the one where it's always kind of the clean is a dirty word. And so what we're starting to see is that the department is really taking a position that anytime anything's getting cleaned or anything like that is kind of going to hit this janitorial building maintenance usage. And so some of the cases we'll talk about will kind of show some of that application. The one thing that there has been a push in recent years, hasn't quite gotten there yet, is for it to especially be legislated out. It created a specific exemption for the manufacturing process. The temporary employees was a big push for manufacturers, and that kind of got removed with some of the surplus items. The hope is that kind of down the road that it's going to get legislated out for the manufacturing exemption as well too. Not the case yet, but it is in the food manufacturing process, but not necessarily the manufacturing and traditional manufacturing. Landscaping, there's been some issues with landscaping, and the big key with this one is kind of where site clearing, general excavation kind of ends and where true kind of landscaping, if you will, begins. So basically anything that relates to the establishment or maintenance of a landscape is going to be the taxable kind of landscaping piece. But there's starting to be items of site clearing and kind of moving trees and stuff like that for power lines and things of that nature that have slowly kind of slid into the purview of the department's taxability. So that's just something to kind of pay attention to in the future to see, whether or not a brighter line gets drawn for things like reclamation, site clearing, general excavation. Touched on this already. This isn't necessarily a specific taxability item, but the limited application of decided cases, and these the 5 cases we talk about, a lot of them will have that common theme of the department has really limited those cases to say, unless your facts are specifically those facts of the decided case, we may decide differently based on what those facts are, even if they're analogous or even if they're similar in every aspect. If they're not kind of one-for-one items, there's a possibility that you're not going to win, and maybe have to do some litigation in the future. And this, what it really leads to is that a lot of similar items may have to get appealed kind of down the road a little bit. So that's kind of been an issue that we see, that a lot of these cases are getting limited. Research and development has kind of always a hot topic issue. The biggest key we want to kind of drive here is not only does it need to be capitalized to qualify for the sales tax exemption, but it does have to be used directly in that research development activity. So we're talking about machinery, equipment, items that are directly being used to kind of complete that R&D piece. Software implementation, the big key here is kind of this distinction of installation and implementation. And where does installation end and where does implementation begin? Because installation would be a taxable piece of software, whereas the implementation is an exempt piece if you have the proper documentation. So the importance of contracts is really highlighted in this situation to show that, hey, here's our fee for the software and what we charge to install. Now, when we implement it, by what we mean implementing in this situation is kind of making sure that the two, multiple software programs can talk to each other, and that the software that you purchased is being configured in a way that it's working in its intended use. So basically, the way the distinction is drawn is once software is kind of downloaded and installed on the server, your installation's over and your implementation begins when you're starting to integrate with other and interface with other software programs. Again, the key in this situation is documenting to make sure that there's a clear distinction in that contract between the installation and implementation. There have been some issues in the past that if you use the same vendor for the full project, the kind of tendency may be for the department to tax it all since they're not being able to draw the line. So if you can use multiple vendors and it makes sense to use multiple vendors, you're going to have better chance of success of getting that implementation piece kind of exempt from sales tax. And I think we've kind of hit on temporary employment quite a bit here. So I'll kind of move on that one so we can kind of talk about the cases here. Kiri, next slide, please. So the second CP activity word here is tax. So I'm going to take a minute to enter that in. Okay, next slide. So in the remaining time that we have, want to kind of talk about some important cases and some sales tax cases that may have some application in your daily activities. We're going to kind of talk about these in groups, and the biggest thing is, while we have the facts, is really these key takeaways. So the first one, and a lot of these cases kind of overall are a few years old now, but we're really starting to see what this application means and how we can apply these in the future. Great Lakes Bar Control is basically what they did is they installed and serviced beer lines. They essentially removed yeast and sediment within the beer tap lines. And essentially the Department of Taxation said, nope, you're cleaning beer lines. This is a building maintenance and janitorial service. And basically BTA held, Supreme Court affirmed that this is not a maintenance and it doesn't fit in the plain meaning of cleaning in the janitorial sense. So really, what the department focused on in this situation is the kind of the dictionary definition of what cleaning meant. It seems to limit the application of building maintenance and janitorial taxability, and kind of tries to separate out. The case talked about items such as floor and window cleaning, vacuuming, dusting, your traditional janitorial stuff falling underneath that taxability. And if it doesn't, it's exempt from sales tax. It is really trying to limit that reach. But what we've seen, and especially the key takeaway, that this first bullet point is kind of troubling, in that the department's current position is that the holding of this case only contemplates the maintenance of beer lines. So presumably, if you had somebody come in and they were maintaining soda lines or maintaining something along those lines, it could technically be taxable. We've had a few situations where we've tried to basically do analogous and parallel facts of what Great Lakes was, and this is kind of the response we've received from the department, unfortunately. So what that's going to mean is that the similar fact patterns are going to need to be litigated, because if you are not talking about beer line cleaning only, you could be running afoul of the department's position. Next slide, please. So kind of in that same vein, and this is kind of that the cleaning janitorial service is Paycar versus McLean. So basically Paycar manufactured commercial vehicles, and they were assessed on a variety of services that were treated as janitorial building maintenance services. Purge solvents, chemicals used to maintain manufacturing and kind of keep them in working order, kind of using that otherwise necessary for manufacturing. But again, it's kind of centered around what the department viewed as cleaning equipment, and not necessarily items that were being used in the manufacturing process. Unfortunately, this case was appealed. Unfortunately for taxpayers and for people who may be relying on it, it was settled, so there was not a decision that was issued by the Department of Taxation. However, there are a couple of key takeaways here, in that it's possible that the Department of Taxation understands that their position that if you don't have specific beer line facts, a Great Lakes argument, if you will, that you can advance this otherwise necessary argument. But also too, what it's finding out again is that the Department of Taxation is still treating the cleaning of the manufacturing process as taxable at the audit level. We've had a few situations, a couple of them where we've had almost identical facts that are unfortunately still going through the appeal process right now. Again, good news in this situation is that we think that there's possibility of settlements, but if you actually want that answer so you know how to treat it in the future, it may take a couple levels of appeals, unfortunately. Next slide, please. So nationwide, again, another one that's been out for a couple of years. Basically, what this is in a nutshell is that building-wide data cabling, your Cat 5, your Cat 6 data cabling to fit an entire building, is now considered part of real property. For years and years, up until nationwide appealed this, it was being held as a taxable business fixture. So in that situation, the contractor would buy everything exempt from sales tax and charge sales tax to the vendor. Basically, this was a prepackaged decision, if you will. The department didn't really contest it. They said, all right, internet's here to stay. It's common to buildings. You're not going to take your Cat 5 data cabling with you. And so that is now an exempt real property contract. Again, key takeaways is that, just like a lot of these other cases, the holding of this case is very narrow, and it only contemplates building-wide Cat 5 and Cat 6 data cabling. Couple additional takeaways and situations that we've actually run into: does not cover anything other than Cat 5, Cat 6. So fiber right now, the department is still holding as taxable. So if you are getting fiber instead of Cat 5, Cat 6, for right now, the position is that it's going to be taxable business fixture, and it's kind of being handled under the old rules. And also too, as always, and I believe this kind of makes sense a little bit, is it doesn't apply to kind of business fixtures and specialty data cabling. So if there's something that you are putting data cabling in for that may not necessarily relate to the building and it relates to a specific process, we kind of always in these situations pick on the server rooms and things of that nature. So if there's kind of something above and beyond what the additional or what's needed to kind of run the building, they're still going to review for that business fixture analysis. The question in this situation, and especially when we talk about invoicing and contracting, might be less is more. And maybe kind of a practical tip is if you can kind of say Cat 5, Cat 6 data cabling, you can at least build your argument, say it's building wide, because they are still going to do that specialty business fixture analysis. Next slide, please. And so the last two cases, while covering two completely different issues, kind of have a common theme related to the resale exemption. First one's Carvo Paving v. Testa, basically a construction contractor got assessed use tax on this purchases of concrete barriers, lights, signs, message boards, all items that they were being used to complete a construction contract with the Department of Transportation. And basically these items were required as part of the contract. Carvo was able to claim that they bought this equipment specifically for resale and that it was an exempt purchase on their end that they would then kind of resell, if you will, to the Ohio Department of Transportation. Now, while it was a good result for Carvo, this also is a point of caution because it can create a sales tax liability for contractors in a certain situation. Carvo in this situation was lucky that they were selling to an exempt entity, the Department of Transportation, but if this is a taxable job, if you're doing it for a private entity or if you're building a parking lot for a taxable customer and you have to use these same items, it can be a trap in that it could actually create a sales tax liability for construction contractors. And so, the general rule has always been that items such as these concrete barriers and kind of these general condition items that don't ultimately get transferred to the person who's having their building built or their road constructed, those items are being consumed by the contractor. This kind of flips it on its head for a little bit, and it kind of talks about the necessity of these items as part of the contract. So could become a trap for the unwary and create that sales tax liability. And so it's just kind of another layer for construction contractors to think of if they didn't have anything else through their contracts, for sure. And then the original enforcement, again, department trying to narrow it, was limited to the 9th District Court of Appeals, which is up in Northeast Ohio. However, this application has since been expanded to statewide. They kind of got some pushback on that one. So this case is now kind of a statewide case. But again, key takeaway is that it could essentially be a trap. Next slide, please. And so the last case we're going to talk about here in the last piece is the Cincinnati Reds versus Testa. And this is an interesting case. If you have time to ever read this decision, it actually goes on a long diatribe. And I think the Supreme Court might be Cincinnati Reds fans. I'm not quite sure. But basically what happened was they were assessed use tax on purchase of promotional items to be distributed at Reds home games, so a bobblehead or a ball or some type of giveaway in that situation. So this case went all the way up to the Ohio Supreme Court because the Department of Taxation assessed use tax to basically say these promotional items weren't included in the price, but were turning to be given away by the Reds. That there was no expectation, if you will, to receive these promotional items. Supreme Court reversed the BTA, stating that fans basically had the expectation of receiving that promotional item with the purchase of the game ticket, and that they were an explicit part of the bargain. So there's a lot of testimony from the Reds basically saying that the price is kind of built into all of the tickets that were included, and so basically that they bought these items with the purpose of resale. So a couple takeaways on this situation again is that it expands what may qualify under the resale exemption. So if you purchase items that may kind of be transferred for the use, if you're basically buying something and there is an expectation of what those items are going to be used for, or what that charge is for, they could be kind of qualifying under that resale exemption. So it just kind of makes people kind of get a little more creative and understand what that resale exemption really means. And it may really create a sales tax collection requirement, again, another trap on kind of certain ancillary items, transfers of tangible property, things of that nature. So again, while, the Reds got a good result in the situation, kind of some of the questions beg is, will they have to start charging sales tax on a portion of their tickets going forward? Someone buys a Reds ticket for $20, is there going to be a sales tax piece on that one? There was no sales tax audit that was part of this appeal. And that was kind of part of the play there, is that there was no way for the department to assess any of their tax going forward. The Reds may not be so lucky. And it just gives people more things to think about, is what am I buying? What am I selling? And kind of how do we capture the tax properly in that situation? So again, kind of more of a thing to think about from that standpoint there. Next slide, please. At this point, we've reached the third activity word. That word is update. So if you want to enter that in. Next slide. And from there, I think that is everything. I know we're out of time for now, but I did see there was a couple of questions that did come through, and be happy to get to those answers for the attendees who sent those in. And if anything else pops up, feel free to give either Matt or I a call or email, and be happy to answer any questions you may have.